Hey guys, this is Steven, founder of Phoenix FXC. I just wanted to do a video on entries because I know a lot of you guys struggle with entries and exits. So let's just get started. In this picture, this is a basic picture doodle of a market moving. So right here we'd have the market moving down. Let's call this a support line, and we see the market bounce. Typically, you'd want to see the market bounce a couple of times off of a support line. So let's say that it bounces, let's change this to black. Let's say that it bounces here, boom, boom. You can enter here, or you can wait for it to come down like this, test this again, and make your entry point here. That's a little bit more common to have at least 2, maybe 3 tests on a support or resistance line. Up here could be resistance. This would create a flat channel, by the way, and right here would be the breakout. So you could enter here if you knew for sure that this was really strong and it was going to bounce off. But since this is the first one, most people would wait, see bounce, bounce, wait for it to bounce here, and either enter here or wait for the third bounce. Now, since this is a channel, technically you can base your entries off of here, wait for it to come here. If you don't see a candle print past up here, then you know that this is going to be a valid resistance line and that it's going to come back down, in which case you could scalp this. You could enter here and ride this back down to here. Wait to see if this breaks through the support line. See if a candle prints past it. And if it breaks it, then you could go down for a sell. But if it doesn't break it, then you'd know this is going to continue in the channel. And I personally, if you couldn't tell, like channels. So then you'd enter here and go back here. Now typically, a lot of traders like to enter after a couple bounces off of a resistance line or a support line. So keep that in mind. But with channels, it makes it a little bit easier for you. And right here could also be an entry point. So you could ride this scalp down, wait to see if it prints past. If it doesn't, then you know it's valid. Can go back in here, take an entry, ride it up, and then wait. Let's say the candle print is past. All right, now you know that you can either take profit right here and enter another buy, or continue your buy and go on for a bigger buy. Who knows how far it could go. So at each of these entries, you could look for candlestick patterns. You can look for market structure, W's, M's, double tops, double bottoms. We've already talked about bounces off support and resistance. I'd also like to mention Fibonacci retracements. Fibonacci is the numbers that are in all of life. So this includes trading, but it's highly psychology based. So while it does work, it doesn't work all of the time, but it is pretty cool. Supply and demand zones are really cool as well. And we'll go over a little bit more of this in depth, and then spikes in volume. We'll go over that too. So yeah, here's a channel. Here's some basics on entries. Let's go over a little bit more. So entries are a really big part of your strategies, obviously. They play a key role in your mindset, and they give you confidence in trades. Because if you know your entry's on point, you can feel confident in what you're doing in your setup, which is going to make your mindset right and going to keep your emotions in check. So entries are important. Some traders base their entries on pure fundamental analysis, like news, economic events, and so on. Best place for this, we actually have it here at Phoenix FXC. We give you some information about Forex news. Here you go. These are the news events that are already done. In 2 days, we're going to have gross domestic product monthly and all this stuff. Not too long ago, we had FOMC. Lots of news events. You want to check this every day because you don't know what's going to mess you up. These high impact news will move the markets. So you can base your entries off of news when it hits. If it's high impact, low impact, probably not. Medium impact, it's like I don't know, 50-50. But news is a big thing that you need to be taking into account of your entries and your existing trades for sure. Some traders use sentiment analysis. I use it. Market psychology of traders, institutions, stuff like that. You can even get into a little bit of the market maker method with psychology. Um, and then technical analysis, obviously, we're going to go over a lot of technical analysis because it's one of the easier, and well, not necessarily easy, but one of the more common ways to judge your entries. And some traders use one of these. A lot of traders are technical traders. Some traders, like me, use all three, or maybe just technical and fundamental. It just depends. But you can use any combination that you want, practice it, and figure out what works for you. In regards to technical analysis, like I said in this little doodle, you can use. Let's see, where did that go? You can use candlestick patterns. You can use market structure. You can use channels. I highly recommend channels. I love them. You can use indicators. RSI is a good one. ADX is okay. TDI is favored by a lot of people who love the market maker method, and TDI is pretty cool. So trend lines, support and resistance, stuff we've already gone over. Harmonic patterns, you can use them. They're pretty reliable if you can get good at them. Divergence, I'm not going to go over that, but divergence is cool if you want to look that up. Volume, I am going to go over this and tell you how you can kind of base it off of. Reversals, that's with levels. This is market maker method stuff. All of these things can be used for entries, all of them, guys. But support and resistance and trend lines, most basic stuff to find good entries. We'll go over these a little bit more in depth in a minute. There are traders out there, naked traders, who solely trade off of support, resistance, trend lines, triangles, and wedges. They don't even use channels. They don't need to. Typically, traders are going to wait for a bounce or a break off of support and resistance to trade, though, and that includes trend lines. We call this taps or touches. At least 2 times, could be 3. We'll go over this more. You can also look for candlestick patterns right before. We've already mentioned that. But any combination of these things can form a strategy for trading, and that's what you want to do. You want to figure out what strategies work. I personally don't use a lot of indicators, so you're not going to see me talk about a lot of indicators in this video, by the way. Let's see. So let's talk about time frames too, because time frames are important. Most traders for entries, they're going to use the H1. They might use the H4. You get crazy traders who like to scalp the minute, the 15-minute, and the 30. It's totally possible. It's really hard when you're new. You've got to learn your stuff. You got to keep your emotions in check. You've got to have a good mindset. But the H1's pretty safe. The H4 is pretty safe, and the daily is pretty safe, and so is the weekly. The higher the time frame, the stronger the pattern of whatever you're seeing. If you're seeing a W on the daily, if you're seeing a W on the 4-hour, it's going to be stronger market structure. If you're seeing it on the 15-minute, chances are it's not the most reliable. But the smaller time frames can kind of tell you what's going on in the market and maybe even help you pinpoint entries. Smaller time frames can be helpful. They can be especially helpful to pinpoint support and resistance, Fibonacci, and stuff like that. But patterns, like I said, more reliable on any patterns, market structure patterns, candlestick patterns, more reliable on higher time frames. Don't stress yourself out on smaller time frames when you're new, guys. Don't do it. Small time frames, good for when you're more advanced and want to scalp. When you're new, stick to higher time frames. It'll be easier for you, and you'll stress yourself out less. So let's move on into candlestick patterns, because that's a good one. These right here, highly reliable bearish reversal patterns. Ignore the equities. That's for equity trading. You want to pay attention to the FX. So you see abandoned baby, dark cloud cover, evening doji star, evening star. These ones right here I see a lot. 3 inside down and 3 outside down. And then these are some moderately reliable bearish reversal patterns. Most of these are still pretty reliable, like engulfing, dojis, hanging mans. A lot of these gravestones, a lot of these are still very reliable. These are some highly reliable bearish reversal patterns. and some moderately reliable bullish reversal patterns. And feel free to pause this if you need to take a look at these because they're important. And so I mentioned earlier volume. Volume is a pretty cool thing, and I'm going to tell you why. In MetaTrader 4, when you see volume, you're seeing what's called tick volume. Most simple way to describe tick volume is the measurement of price fluctuations moving up or down. Tick volume is considered level 1 volume. It's a good indicator of strength in the market activity in every candlestick that you see, and low tick volume means low struggle for market movement. High tick volume would mean the opposite. However, tick volume, it's not real volume. Real volume is level 2 volume, made of bid and ask volume, buys or sell orders executed in the open market, the intrabank market. Since there's no central exchange or official volume data, you can't actually track real bids and ask in Forex without specialized software like order flow or something. But when you see candlesticks on your charts, you're actually seeing candlesticks represent price fluctuations from the activity of traders who create real volume in the actual markets, the banks, the interbank market. So remember, just remember this about volume. Candles in MetaTrader 4, they're not bid and ask candles. You're not seeing bid and ask volume from the candles. You're only seeing the tick volume. If you could see real bid and ask volume in MetaTrader 4, visually speaking, there would be more. If there's more sells in the market when buyers fail to drive price upwards, you're going to see a down close candle. Down close and up close bar can differ in color based on your settings, but I use green and red, so just keep that in mind. When there are more buys in the markets at that time, or if sellers fail to drive price down, you're going to see an up close candle. That would be a green candle for my colors, at least. The candles vary in size based on the volume or price fluctuations at that time. But since we don't see real volume in Forex, if you're not utilizing special software to see the real volume, then you have to rely on tick volume. Tick volume represents, like I said earlier, the struggle in the price fluctuation. When you see candlesticks in MetaTrader 4 move, the candle will move fast when tick volume is low and will move less when tick volume is high. If you're looking to trade based on volume, then note that buyers require increasing numbers to move price. So look for rising volumes because this indicates rising activity in the markets. If volume has little movement for a while, usually in ranging, you may know it as consolidating markets that have no clear trend, then you might see sudden increases in volume, and this can be indicative of market possibly reversing soon. So watch for spikes of volume and sharp movements of price. To add a little bit of market psychology, because like I said, I like sentiment analysis behind the real volume, which is, again, I'm going to keep reminding you this is tick volume in MetaTrader 4. Think about why a market would move certain ways. Just think about it. Traders who hesitate and are afraid they might miss a major move will start executing a bunch of sell orders at market highs. This is going to exhaust the buyers and could possibly even cause sudden movements in price. This would cause high activity on MetaTrader 4, and this could show as a spike in the tick volume. Or if traders couldn't overpower the buyers, price might actually continue upwards. So just keep in mind, the key thing about volume is volume moves price. In other words, it creates price action. This creates the supply and demand zones, the support and resistance lines, trend lines, everything you see on your charts. It's just a result and a visual representation of volume moving the market, which is really cool. I highly recommend you learn more about volume. Although this information is pretty in-depth, so good luck finding better than this. So trend lines are one of the most basic tools in the trader's arsenal. They're like support and resistance line. Like we went over earlier, you're going to want to connect but I would say typically 3 or more highs or lows with a trend line to make it valid. You want to look at how price is reacting around the trend line, and that's going to tell you what price could possibly do. Remember that when you do trend lines, you want to connect it to the wicks. 2 to 3 wicks need to be connected, like you see here. 1, 2, 3. And then you can also see the price moved on it. It acts like resistance right here. This is an example of not a valid trend line. Do not do your trend lines like this. This is not good. So we mentioned trend lines. We also mentioned support and resistance and how important it is. So let's get into a little bit of in-depth about support and resistance so you can utilize it for better entries. Support and resistance are typically invisible points in the market where price tends to reverse. Think of resistance as an invisible ceiling and support as an invisible floor. When volume moves price and it rises to a point in the market, usually multiple times, but it doesn't break this point, it's likely an indication that it's a line of resistance. When the market price falls to a point in the market, usually multiple times, but doesn't break this point, it's likely an indication of a line of support. Traditional support and resistance lines, or horizontal, however, trend lines, can be used as a form of support and resistance like I just showed you previously right here. This would be a trend line, but it's a resistance line. Tap, tap, boom, it falls. So let's get into depth and let's talk about what causes resistance. When volume moves price and it hits a resistance point and then it falls back down, this is caused by a few different groups of traders making up that volume. One group are the sellers pushing the market down, and another group are the buyers who bought at support and sold around that visible line. The last group is buyers who bought around the resistance line and are trapped when the price started to fall. You don't want to be those guys. All of these groups end up working collectively to create the volume that sends price lower. An important thing to note is that these groups make up, these we just talked about, make up the supply and demand. Keep that in mind. So now let's move to what causes support, the inverse. When volume moves price and it hits a support point, then rises back up. This is caused by a few different groups of traders that will make up the volume that makes this happen. Because remember, volume is what moves price. The first group is the buyers who are pushing the market upwards. The second group is a group of traders that will push a buy order around the level of support and sell around the next level of resistance. That last group is the group of traders who sold around the level of support and got trapped when price began to rise. You don't want to be those guys. These three groups collectively work to make up the volume that sends price up. Inverse to sellers making the supply and demand, buyers make up the demand. So this is cool. When there is more supply than demand, the price tends in the market, or the market price tends to fall. Inversely, when there is more demand than supply, the price in the market tends to rise. Additionally, when you're identifying a trend in the market, it's important that you learn to buy at levels of support in a downtrend, market lows, sometimes valleys, and sell at levels of resistance in an uptrend, market highs, sometimes called peaks. Buying at support levels, selling at resistance levels is typically considered a good point of entry for a trade. Keep this in mind. You can make a lot of money off of just learning to time your buys and sells at support and resistance. It also potentially reduces the risk of the trade because you know that it's going to be valid. Note that if price breaks a support level, this can be used as a good entry point for a sell, and if price breaks a resistance level, this can be used as a good entry point for a buy. If you read, when we talked about volume, volume can tell you right around if sellers are getting exhausted or if buyers are getting exhausted and if the market's going to reverse. This can also happen with candlestick patterns like I already showed you. And then we have supply and demand zones. Let's quickly go over this. Supply and, because these can be used for entries too. Supply and demand, it's a simple concept, and when correctly used can be really powerful. The two major rules in supply and demand, guys, is that first, when there is more supply than demand, prices got to go down at some point. Second rule, when there's more demand than supply, prices have got to go up. So based on these two rules, if you buy when there are more willing sellers in a supply zone or sell when there are more willing sellers in a demand zone, you're going to lose money. Don't do this. Do not do that. However, that means the inverse is also true. When in a supply zone, you should sell, and when in a demand zone, you should buy. That being said, make sure you use all the tools in your arsenal, like trend lines, use support and resistance line along with your supply and demand. Maybe use Fibonacci if you like it. Use your candlestick patterns. Get your multiple confirmations before executing a trade. Some people tell you get 5 confirmations. Some people will say 3. It's up to you. Find out what works for you. But that's why we have demo trading, so you can practice all this. And everything I just named to you, this all kind of makes up naked trading. And if you've never read The Naked Forex, highly recommend you do that. It simplifies trading and makes it a lot easier. Things will click when you read this book. And naked trading, so much easier on your eyes than trying to track a bunch of different indicators. But if you use indicators, you can use stuff like the basic RSI oscillator. Um, it's good for divergence, even though I'm not going to talk about divergence. It's excellent for that. And ADX, like I said, is okay. TDI is really good. Indicators can help you with entries. I see indicators as more as helpful, not actual indications to get in the market. Reason being, indicators are tools that just take the data that you already see on the charts and they just display it a different way in whatever form of indication, whether it's a wave, whether it's a stochastic, whether it's an RSI, whether it's a TDI, it's whatever. They're just displaying the data of the actual tick fluctuations, the actual candles in a different way. So it's up to you how you do it. But all of these things can help you with your entries, guys. My personal recommendation, like I said, learn channels. I love channels. They're great. Learn support and resistance. That's going to help you a lot. And memorize candlestick patterns. Those things right there are basics, and they can help you so much with your entries. That and the right time frames. Things like volume, Fibonacci, those are a little bit more advanced. Divergence, a little bit more advanced, can also help you. So, that being said, guys, if you have any questions, please feel free to reach out to me, facebook.com/sbhooley. Please join our Facebook group if you're not in it already. This is the URL to it. We've got a lot of people here. This thing grows every day, guys. We're already at about 8,000 users, and it grows every day. Check out our Instagram for daily motivation, mindset, all that kind of stuff. If you want to catch our trades, telegram.me/Phoenix FXC. That's where we post our signals and updates on the group. And then if you can't use Telegram, twitter.com/Phoenix FXC. We also post our signals there, and our signals are free. If you guys want to join our group chats, please feel free to join Trades and Analysis. We're actually shutting trading education down. We've opened up telegram.me/Phoenix Education. So that's telegram.me/Phoenix Education. Okay, and then lastly, guys, if you're looking for a mentor, which I highly recommend that you speed up your profitability and your trading skills by getting a mentor, we've got an awesome trading school program. Check this out. We teach advanced education in 1-week cycles. Currently, you have multiple teachers to choose from. Each teacher has a private classroom chat, which upon purchase, you're going to receive a link instantly to join that class. And then we try to record all these live classes, which are the webinars, so that if you're in different time zones, have different schedules or whatever, you can still watch these classes and it won't affect you. You'll still be able to partake in everything. And then you have instant 24/7 access to your teacher's page with these recordings. If you have any questions, feel free to reach out to me. We've got testimonials here. This is phoenixfxc.com/trading school. Schedules, we've got multiple teachers. Guys, take advantage of this. It's only $100. You're not going to find anything cheaper, and our students kill it. They kill it. You're even going to find video testimonials on our homepage, and these video testimonials are awesome. They talk about how they love Phoenix, and they talk about how they love the trading school. So that's our paid education stuff. Guys, thank you for watching this video on entries. Really appreciate it. Have a great day.